Almost officially, Russia has voiced the three possible responses to the Russian oil price cap introduced by Western countries. But oil continues to lose value. The reason lies in the voiced options themselves. Options suggest a complete ban on oil exports to countries that supported the price cap, including through intermediaries. The second option being considered would prohibit exports under contracts that include the price ceiling condition. And the third one would set maximum discounts of Russia's Urals crude to international benchmarks for sales to be allowed. The first option is the toughest one. The others will hardly have a severe impact on the global economy. Investors believe that the energy market will not be affected, and the general price level may even decline. However, these are just assumptions, while there is no final decision. Market participants will remain nervous. This, in turn, will keep exerting pressure on oil quotes. Against this background, even the news about the upcoming economic recovery in China failed to prevent oil prices from falling. The world's largest crude oil importer signals an easing of its quarantine protocols, raising hopes for changes to its zero-tolerance policy towards local COVID-19 cases and improving demand prospects. However, concerns about a potential recession-driven slump in the global demand are still keeping investors on their toes. Manufacturing activity in advanced economies such as the US and Europe shows signs of a slowdown due to tougher financial conditions. In addition, US government data showed a 5.2 million barrel decline in crude stocks, while gasoline and distillate inventories posted big builds. This indicates that the demand remains weak. According to the trading chart, Brent crude oil continued to lose value and fell below $77 per barrel. Thus, there is just 1% left for the quote to reach the levels of last December. Given the current dynamic, it can be assumed that the downtrend will remain intact and sellers will drag the benchmark down to the support level of 70. However, such a steep drop may signal oversold conditions. Thus, a subsequent decline in the volume of short positions may result in a pullback up. Well, we will see. As for the ruble, the situation has barely changed. The dollar keeps trading around 63 rubles. However, in after-hours trading, the dollar fell only to 61 rubles, whereas the day before it fell below 60 rubles. To extend gains, the quote needs to break through the level of 63.5. In this case, the way to the main resistance level of 65 will open. The current dynamic directly reflects the market's reaction to the options being considered by Russia as response mechanism to the oil price cap. According to many market participants, these options may lead to a drop in Moscow's profits and budget revenues, which is a negative factor for the Russian currency. However, the market situation will hardly change dramatically until the final decision is made. Speaking of gold, it posted impressive gains. The yellow metal is trading upwards amid a rising risk of a global recession. Given that today's report from the Labor Department is expected to show a further increase in the US weekly jobless claims, gold may well advance to $1,800 per ounce. That's even before data on producer prices is released. This means that the metal may enter the week slightly above this mark. And that's all for now. We wish you profitable deals. See our channel with a new video in a couple of hours.